Got a great Goofy Award for you today. Plus, I've got a shocking stat and a very serious issue. And I think, in fact, it will be the dominant financial issue going over the next 15 years. It'll move other things. And you've got to be aware of it. I've got a new stat on that for you. Time now for the quote of the week. No, this quote was not inspired by Minister of Health Jane Philpott's use of a limo service. One day, $1,700 tax dollars, something she'd never do personally. No, it's not inspired by that, but it could have been. It's by Frank Hebert in the book Children of Dune, in quotes. Governments, if they endure, always tend increasingly toward aristocratic forms. No government in history has been known to evade this problem. And as the aristocracy develops, governments tend more and more to act exclusively in the interests of the ruling class, whether that class be hereditary royalty, oligarchs of financial empires, or entrenched bureaucracy. You know what? That's so good. I got to read it again. Governments, if they endure, always tend increasingly toward aristocratic forms. No government in history has been known to evade the pattern. Think about that. Whether it's the private jetting, I could go to so many examples, and every time I do, we deserve it because anybody who gets offended because it's their pet political favorite goes nuts. I don't have to go any further than Hillary Clinton, who says she hasn't driven a car in 25 years because she's been in limos, presidential suites. It's well chronicled. President Obama, $70 million in personal travel on Air Force One for vacations. Justin Trudeau's had his 5th vacation since becoming prime minister. What, is it 10 months ago, 9 months ago? Are you kidding me? The list goes on. No government in history has been known to evade the pattern of moving increasingly toward aristocratic forms. Great quote by Frank Herbert, Children of Dune. Let's get on to our key interview of the week. I've got with me Eric Coffin. So great to welcome him back to the show. Eric, thanks for finding time this weekend.
Thanks for having me back, Mike.
Of course, Eric is founder of Hard Rock Advisory. And I got to say this, Eric, we're in a business, whether I'm talking about where interest rates are going or what this economic thing is doing or, talking about individual stocks, we're in a business that's really bottom line. And that is, how are you doing for me? Well, I just got to say, Hard Rock Advisory added 11 companies to its list in the past year. I hope everyone's listening to me. They added 11 companies to its list, and those 11 stocks have averaged a total return of 340% so far. I think you should retire, actually, on that one. That's like having a 5-home-run game. It ain't getting better than that.
Yeah, I mean, hopefully you're wrong, but I have to be realistic when it comes to these things. I know my old mentor, Bob Bishop, telling me back in the day when he passed his subscriber list on to my brother and I, make sure you go out at the top. It really sucks to go out at the bottom.
Well, I'm not suggesting you retire, but I mean, that's a hell of a market. But the thing you, of course, did right with the Hard Rock Advisory is you identified two things, it would seem to me, and please add to them, but you identified, hey, this is the beginning of a move in gold, a significant move in gold. But then really interesting, I thought, is you identified, and you did it for our audience here, what kind of companies may be some sort of boom beneficiaries of this. And for example, I know in the last, few months, you've had 3 of those companies get takeover offers because you were looking for a particular kind of situation.
Yeah, I was trying to focus, at the tail end of the bear market when it was impossible to raise money. The only companies I was able to get interested in myself and talk to readers about were, what I refer to as high margin situations. Most of these were development level companies, and by that I mean they had managed to define a resource, but that resource wasn't in production yet. But these were high margin, relatively low capital cost situations, the type of things that a larger mining company would be interested in because it would have a really good marginal return if they bought it, which is basically a roundabout, complicated way of saying they were takeover targets. And indeed, 3 of those companies in the last 6 months have been taken out. There were a couple of other ones taken out late last year. I think I've had 7 in the last year that were taken out, which has made things a little tricky, I have to admit, because it's getting harder and harder to find good development level stories because they're basically disappearing. I mean, you've got a bunch of big miners that have maybe not the smartest acquisitions they made during the last cycle. And my sense is simply that the mining sector has probably changed for the better. I mean, they're being a bit smarter this time. It's not just about size. There are companies out there doing really well because they have giant, crappy resources, frankly, and that they're what are called optionality plays, and that's one way to go if you think the gold price is really going to move. My personal philosophy has always been I'm interested in looking at companies that have projects to me make economic sense. I would rather have the inherent protection of ounces that make sense, that are producible at a profit, rather than saying, I'm going to pick this stock because if gold goes to $2,000, this might be economic. I'm interested in stuff that makes sense right now. And those are obviously the first ones that are going to go. Those are the first ones that companies come after. And the list is getting short, I got to say. There's not many good development stories out there.
Well, it's funny. That's absolutely what occurs to me is when you, I love it when you identify, a move in the market, the move proves out, and then everybody still is the way. Seriously, it may be the thing I dislike most about investing, and in your case, giving advice like this is everybody's, oh, that's great, Eric. What have you done for me lately? You know, what's next?
Yeah.
And as you say, the environment gets more difficult once, you obviously were early in identifying these situations, but now, as money moves and the market moves higher, price of gold moves higher, then there's more and more eyes searching for the same thing, and slowly it depletes the number available to you. So, it becomes a more difficult market.
Yeah, and it is. I mean, one thing that I've shifted to a couple of other things, and then partially their personal preference. I mean, I grew up in a mining family. My late brother and I owned an exploration business way back in the day. I mean, he was the technical side, I was the money side, and I've always had a soft spot for exploration stories. And part of my sense of the change here wasn't just that gold had bottomed, but more importantly that the sector had bottomed, and by that, I'm not just talking about a change in gold prices. The more important thing, I think, is a change in sentiment.
Yes.
And what that means is you do have people increasingly focusing farther down the food chain. You can see the money moving down the food chain. If you look at the venture exchange, for instance, the number of companies that have been doing $5 and $10 million financings in the last 3 months has just exploded. I mean, you've got money looking for this stuff. And the situation that sets up, that allows me to try to find, I'm still adding new development companies. The last company I added was a new development level company, but I'm also adding exploration stories where I see the potential for very large target size. And what I'm really trying to find for readers is stories where if I can be one of the first guys in, or ideally the first guy in, and the market starts to latch onto it later, you set up a situation where you get a substantial amount of anticipatory buying as you get close to the real hardcore testing, the drilling, the truth machine. And I've managed to find a few of those, and what I keep telling readers is, look, we started talking about this at 20 cents. It's now 80 cents. They haven't delivered any drill results yet. You have your marching orders. You know what to do. You take enough money off the table that this stock owes you nothing. Ideally, you take enough money off the table that you're up 100%. You got a free ride on a drill program. If it works, great. If it doesn't, we move on to the next.
And over the years, I mean, if you've been involved in this so long, as you say, right from the ground level into the analytical side of things only, that, writing the Hard Rock Advisory, I mean, there's ways to reduce the risk here, and you've just added to one of them I find that we got too many people, especially when you get into a positive market like this, who want to be the all-time only home run ever hit. And that's not how you manage money, and that's not how you are realistic about the risks associated with this sector.
Well, I got to be, to be honest, I'm one of the, I've been that guy in the past, believe me.
Oh,
and
were you sitting right beside me at the time, Eric? Because I was on the same bus, believe me.
Oh, well, one of the things, I occasionally get, emails from long-term subscribers that are, and they're guys that have become friends, and they're just, they're being kind of, they're joking with me and going like, are you gonna tell me to take profits again? And I keep telling them, like, look, we just went through 5 years of bear market. I promised myself the whole way through that, I was going to tell you guys this over and over and over and over again, because there's so many things on the list right now, and this is how it goes early in bull markets, because this was a market that got taken apart. I mean, it was down 85%. When these things turn, The companies that get focused on tend to generate large gains quickly. That's great. And yes, some of these companies, I'm hoping, make real discoveries, and they're trading at 10 times what they are now. But even so, you've got to play the averages. The simple fact of the matter is, most exploration programs will not work out in the end. Most properties will not become mines in the end. You've got to play the averages. You have to.
Interesting stuff, though. I've got to take a break. I've got to come back. Eric's, of course, Hard Rock Advisory. You can find him HAR. Oh, wait. Can I start that again? HRAadvisory.com. HRAadvisory.com. Hard Rock Advisory. But I want to ask, well, come back to this statement right there that gold is bottom. We'll ask him about that within that context. But also, I want to come back to something he said about which companies he's looking to identify now as the place to be. Eric Coffin, as I said earlier on, come on, 11 companies added to his list in the last year, the average return of 340%. Let me just put it this way. My portfolio didn't do that well. I'll come back with Eric in just a couple of minutes on the Money Talks Network. Coming up, I've got a shocking stat. It may be the financial story of the next 15 years. In fact, I'm betting it is. I'm betting large that it is. I'll chat with you about that in a couple of minutes' time. But right now, Eric Coffin, he's Hard Rock Advisory, HRAadvisory.com. And again, I want to reiterate, I get a lot of mail coming up, and some say I disagree with that or you know what, in the end, and this is a business that's straightforward. Did you get it right? There's no other stories that are important. Did you get it right? Well, Eric Coffin employs a specific approach to the market, to the gold sector. He added 11 companies to his list, spectacular returns to date. Eric, I want to come back to two things that you've mentioned, but let's come back to the kind of company you're looking for right away.
Okay. Okay, I'm going to. I'll mention a couple of different situations, and these two are both development level. I mean, I can come up with a couple of exploration stories as well if you want. I'm picking these two intentionally because I happen to be the last two that I added to the list. The most recent one is a company called GMV Minerals. They've got about 500,000 ounces of low-grade oxide gold in Arizona. I took a look at it. I actually found it because I was doing searches on metallurgical news releases, which is about as exciting as it sounds. But the reason why I was doing that is and this comes back to talking about margin and what makes sense. When you're looking at these low-grade heap leach type deposits, metallurgy is extremely important. And I just sort of tripped over this deal looking at metallurgy results. It has an extremely nice-looking metallurgy. They're doing more tests right now, but it looks like it could be what's called run-of-mine. That has really big impact on the economics of the deposit, but it also looked like it had exploration potential. So I added that to the list at about 20 cents. It's trading at about 65 now. But I'm mentioning that one first because if you want to learn more about that company, there is on the upper right side of my homepage a place where you can just throw in your email, and essentially the report that I gave to subscribers is available for free by just going there and adding your email. The company before that was another one that's called Minetta Porcupine. This was a company I'd looked at years ago, wasn't actually that interested in. They've got a project east of Timmins that has now about 4.5 million ounces on it. It's probably more than that. It's been quite a while since they updated their resource. But this was part of a trend in the last cycle, going to, as many ounces as possible, push the grade down, just basically throw everything in the kitchen sink into a pit. I was never in love with that trend, and I have to say that at one level I was wrong, because if you look at a couple of deals like a Cisco that did that, it worked. It's a trend I maybe shouldn't have ignored, but I did at the time. But why I revisited this company and decided to start covering it was it had been very quiet for the last 2 or 3 years. I talked to management. They had decided they were going to go back and basically drill on the northern half of the property. The geology is different there. It has more potential for high grade. Management had come to the conclusion that the market likes grade. They want grade right now. They want margin. So they're doing a financing right now, and they're about to embark on a big drill program. But it also does have 4.5 million ounces. So if the gold price goes to $1,500 or $1,600, it's got a lot of tailwinds anyway. And if they happen to luck out, and there are a few old holes that show decent potential for high grade, if they can add sort of high grade starter areas to this 4.5 million ounces already have, and that's a pretty good mix of exploration potential and some underpinning with ounces that give you a little bit of safety, and it'll go up if the gold price goes up anyway.
Can you give me the symbol on those two?
Yep. The symbol is GMV.
Yep.
And Moneta Porcupine, the symbol is ME on the TSX.
Yeah. I mean, again, what you're looking for, though, when you're describing that is a situation that you're going to be early on that, and then others might pile in, and then you can, as I say, take some money off the table and see how well their exploration does.
Yeah, I mean, to my knowledge, not to my knowledge, I know for a fact, no one else is following GMV and it was one of those things where, like I said, I came to it through metallurgy, and then when I went and looked at the company, I realized I'd actually known the guy that runs it for 20 years. I hadn't seen him for 10. And I knew the exploration manager for 20 years as well, so I went and sat down with him with that. The other one was one where I think Moneta is starting to pick up some other coverage now, and again, it's because they've got 4.5 million ounces. Like, guys are looking for, show me any company that's got a gold resource, and management themselves says, look, we realize that at current prices, this isn't a fabulous deposit. Though I should say, one thing that actually helped Moneta, and it was one of the things that got my interest, was because it's a Canadian deposit, because it's in Ontario, the drop in the Canadian dollar from basically par down to 75 cents does wonders for their economics. Even though I don't love sort of low grade sulfide deposits, the economics of that deposit have improved substantially just because of the currency change.
Let me come back to, just because there's only a couple minutes left, just your observation on, we're in the seasonality, the period right now where gold does well. If you look in sort of in that September, October, sort of a tradition, if you look, percentages are that it's a good period for it. But what about the overall market? I mean, when you say it's a bull market, does that mean you think the lows are in place and, we can get some gyrations, but we're not going to make new lows, or that you expect it to go kind of, not straight up, but as you know, but I meant pretty jig-jaggy up, though?
Yeah, I mean, I did. Most of the year, I've been saying that I wasn't expecting the summer pullback that everybody else was talking about, because it's not uncommon. I mean, the best analogy that I could find was really 2009. It was obviously a much shorter bear market, but a really, really ugly one for this sector, like it was for every part of the market. When it came out of that, it pretty much moved up for a year, and I think we may be getting a repeat of that. Obviously, in the fall, one of the things we've got to look out for is what the big markets do. I mean, it's going to be hard for the sector to escape if Wall Street gets its head handed to it. And I do have some concerns that we may not have a great fall in New York, because I personally don't understand what's holding prices up. But the trends, physical gold, if you think of actual physical bullion, the big buying season for it in the East, in India and in China, is basically in the fall. They're buying for wedding season, they're buying for New Year's, they're buying for all those things. I've got to hold us at that, Eric, because time's run out, but I'll give the address again, hraadvisory.com. Eric Coffin, back with my shocking stat. Coming up, I got a Goofy Award for you. I mean, this is one of the great examples of all time of shooting yourself in the foot. I mean, it's unbelievable to sabotage one's personal life like this, or their business life, really, is what I'm talking about. Also, I've got Aussie Jura coming up. You got to think about this. I mean, we've had a really strong, dramatic slowdown in real estate in Vancouver. Is that the beginning of something bigger? Luckily, or unfortunately, we've been chronicling this for the last 3 months. But, man, I look at some of those numbers coming out and you think, wow, that's significant. We'll talk about that with Aussie. Drew Zimmerman joining me at the top of the hour live from the trading desk. And as I say, I'll have my Goofy. But right now it's time for my one more thing, by the way. Eric Coffin, hraadvisory.com. hraadvisory.com. Very interesting stuff on what he thinks happening in the gold market. It's for, the stuff we're talking about is for the aggressive part of your portfolio, speculative part of your portfolio. So you always just chat with your investment advisor about where it fits, how much money is involved, that kind of stuff. But it's an interesting thing. And look at that track record Eric's just amassed over the last year. It's shocking. He could have been my shocking stat. But let's move on to that. This is one you really should be aware of. I mean, I appreciate that people don't wake up and say, gee, I wonder about economics, I wonder about finance. Not very many people do that. But you really have to know what's going on in the world. And this is the single biggest thing that's going to hit you in the next 15 years. And it's an issue I've been warning about for several years, and that's the shortfall in public sector pensions. But come on, it's already bankrupted Detroit. It's pushed Chicago into junk bond status. It just bankrupted Puerto Rico.
And this is another one of those, by the way, hate mail subjects, because I point out that the relentless attack on business by public sector labor union elites hurts their pension investments. Well, it's a fact, but one that clearly some people don't like. So I want to move on to this week's shocking stat. Here it is. The U.S. has $1 trillion in public sector pension liabilities that are uncovered. It's a pension gap covering 24 million government workers. It doesn't make any difference who's in power. It's about the math. This is imminently predictable. It is coming down the pike, and we're ignoring it. In our last federal election, not a single politician talked about it. But we, in Canada, has about a $245 billion unfunded liability in the public sector at the federal level. But think about this in the U.S. Since 2009, 25 out of 34 states that had Democratic governors in office had to cut retirement benefits for public sector workers. And about the same percentage, by the way, in states with Republican governors. In other words, it doesn't matter what party's in power because, as I say, it's not politics, it's math. You know that Pennsylvania has a $50 billion unfunded pension obligation. It illustrates the problem for taxpayers and retirees alike. I mean, you got to increase the amount of tax revenues, so taxes have to go up, but they're going to go to pensions as opposed to government services. Or you can reduce the benefits, probably a combination. Or increase the retirement age. Just looked at that in Germany. They had a major report out this week in Germany saying they've got to raise the retirement age to 69. Something's going to give, and nobody in the power elite want to talk about it. Nobody in the establishment. The states, by the way, or in Pennsylvania, for example, it's as I say, great example, projected to spend 43% more this year out of their general tax revenues on pensions. 43% more this year, just in 1 year. That number's going to keep growing. As I say, there are lots of implications to this. But the problem for me, again, is it's not being discussed. That's a huge problem because, again, we don't anticipate, we don't prepare. Well, I'm worried about our public sector pensions. I'm certainly worried about it in the States. And the States is the pivotal key, of course, when you look at global economics. Well, I'll tell you, they got a major problem, as we've clearly predicted on this show. The problem will show up at the civic and at the state level. Well, it's happening now. I'll take a break. I'll come back. Ozzie Jurek, is the slowdown in Vancouver housing prices, is that the beginning of the end? Because if it is, my goodness, that's going to spell problems economically. Plus Drew Zimmerman, plus a goofy. You're on the Money Talks Network. You're listening to Money Talks. Ozzie Jurek joins me on the line now. Ozzie, obviously that real estate prices, especially in Vancouver and Toronto, have been prominent in the news now for several years. But recently, as we've been chronicling, I think 3 months ago was the first time we talked about it, was that, hey, those sales, especially in the Vancouver area, have started to slow down. Well, now I notice it's getting international attention. I'm picking up articles and publications outside of Canada that are talking about, well, really what could be described as an abrupt halt in volume if you look at several areas in Vancouver. And I guess the big question becomes, how do we know when this has become past the regular sort of July, especially August doldrums, into something more significant?
Well, there's two things here, Mike. And first of all, yes, everybody is talking about it. In fact, all the people that have been forecasting crashes for 10 years are now saying, see, I told you so, you know. But you and I talked about that the detached home sales were on a sharp decline. Really, we started in April, May, June. They were down 30% already, this detached home sales. So that isn't a surprise. But when we added the tax, that was a catalyst. And when we are, as you say, looking at the numbers in the first 2 weeks of the month, yes, they're sharply down. Now, are you saying it's serious? I think it's very serious, but it's not yet conclusive, Mike. But let's take a look at those numbers. I mean, the single-family homes in Vancouver last year, the first two weeks, were 565. This year, 169. That's a 71% decline in single-family home sales.
What about condos then? You know, sorry to interrupt, Ozzie. Is it the same thing with condos?
Yeah, condos were 701 sales last year and 379 this year. So that's almost a 50% decline. But when you look at some of the suburbs, I mean, West Vancouver, the single-family home sale was 51 last year, 7 this year. And in Richmond, there were 82 last year and 10 this year. So both of them are over an 88% decline in sales. So they really took it on the chin.
And so we're obviously seeing this. I mean, this is a significant decline in volume. And again, our question is whether this is going to be the harbinger of other things to come. Have we had that sort of pivot shift? Because we certainly had all the markings of that in terms of euphoria, in terms of hype, in terms of public outcry. It's always late on these things, and governments are notorious for acting late on this. And so that's what's got me wondering. I mean, as you said, it's not yet conclusive, and I really agree with you. But what kind of things will you look for to make it conclusive?
Well, right now we're expecting listings to really increase as owners, some of them want to lock in yesterday's price, others actually have to sell. And some of them that have to sell will probably drop their prices. I think lawsuits will mount, and so that negative news environment will continue. But why I'm sort of hesitating to say something more was, remember, just 2008 and 2009, we had a world crisis, big crash, Lehman Group, and so on. And our real estate market tanked in Vancouver in the early first 4 months of 2009 in particular. We've forgotten that. But prices, the big developers dropped their condo prices by 25%. I mean, Mac Realty had full-page ads saying, look, come here, it's a deal of a lifetime. And yet within 9 months, the market stabilized, and we came back to sanity. So I'm saying it's serious, but it's not yet conclusive.
Yeah, and as you say, the last time, and you just mentioned those years, 2008, 2009, of course, we remember it as the credit crisis, and people were worried that all hell was going to break loose. I mean, when you have banks not lending to other banks, that's a problem. This is a credit-driven market, and we've seen, by the way, the Canadian government sort of, starting, I think it was July of 2012, when they keep on restricting further mortgages because they didn't want to get into a subprime mortgage crisis, but we're seeing more of that. I mean, that hasn't stopped. And as you mentioned, in the Vancouver area, you've got the foreign property purchase tax. That was new, but that wasn't that's not the first of the sort of measures taken by, government to try and slow things down.
No question. In fact, last week they tightened the rules further. But I think also Mr. Paulos, our central banker, he blames us for being over-indebted, and then he says we're overvalued, and then he keeps interest rates enormously low and talks down the dollar incessantly, making us cheaper to foreigners. So we have all of that coming together. But for me, these things, normally a major change comes about when there is some big economic news or some international incident, or a trigger point, a tax change, a zoning change, or a change of use in property. When we built the Coquihalla Highway, there was big news. It really helped Kelowna real estate prices, but it hurt Princeton because the old highway was gone. So we have all of the things, but the thing that I'm worried about is that we get into this mass hysteria because markets become the stories, people talk about them. And there's a real fear factor. Some of the realtors telling me, saying, look, I used to have to run around with my multiple offers, and it drove me crazy. Now it's driving me crazy trying to explain to people why they shouldn't be scared to buy, because everybody says, I'm going to wait this one out.
Let me fire this at you very quickly, and we'll have to elaborate on another time, but it seems to me we go in cycles. You first sort of slow down the volume. Then, as you say, you get some people who are forced to sell. So that's what brings about a price adjustment within that. And that's the kind of process that you have to go through to get lower level of prices, and then those lower level of prices then attract buyers at some point, and then you start the up move again, especially in an area like Vancouver. That's an attractive place to be, especially when you're considering the alternatives internationally, not just domestically, but internationally.
100%. We were just rated the third most livable city in the world. We have all of this going for us, and I also believe we live in the world's most unreported inflation and hard assets ever. And I think 10 years from now we'll look at these prices and saying, hey, that was cheap then, just like we do looking back 10 years now. But we will go through a valley, that's for sure.
You better give me a hot property before time runs out.
Okay, we got a great one. It's a nice house in Nanaimo, and it has a bachelor suite, a wired shed, and a private yard, and it's only on at $399, and then only a 5-year home on a large lot in a really desirable Hawthorne neighborhood. 6 bedrooms, 4 bathrooms, a legal 2-bedroom suite, $629.
Yeah, it's funny when you say that. 6 bedroom, 4 bath, legal 2-bedroom suite, $629. If somebody's listening to us from Vancouver, they're going, that is free. someone else is listening from another part of the Canada. Go, how can they ever afford that? It's just relative. But of course, Nanaimo is a beautiful city on the Vancouver Island, easy to get to with the ferries and the float planes, etc. So yeah, the Vancouverites are looking in that, chomping at the bit for that kind of stuff. Ozzy, you go out and have a pleasant weekend. I know you're boating. Thank God you're not golfing, so enjoy it.
Well, thanks, Mike. Well, our market is like golf. You hit the ball down to make it go up. You swing left and it goes right. You swing right, it goes left. The lowest score wins. And then if you ever win, you have to buy the drinks. It's a crazy game.
There you go. Have a great weekend. I'll take a break. I'll come back. I'm going live to the trading desk, and now I've got a Goofy award for you. This Goofy, though, you've probably all heard it, or many of us have heard it, that's for sure. But it's really, I can't imagine a better example of absolutely blowing it for an individual. I'll get to that on the Money Talks Network. Coming up, I've got a Goofy award for you. But right now, Drew Zimmerman joining me live from the trading desk. Drew, I'm just looking at, these are the dog days of summer. I know just watching, obviously I watch the markets, but also all the business news. Everybody's gone on vacation, but one of the things that I was talking to Victor Adair about last week was that sometimes this produces some pretty abrupt moves in the markets because the volume is lower. And I'm looking, I'll just throw out one at you. I mean, I'm sure you were watching it. The Canadian dollar, I think that's 9 straight days up. Oil up too.
Well, exactly, and they go hand in hand, Mike. We had the Canadian dollar, as you said, up 9 days in a row. That's the longest continual up streak we've had in the Canadian dollar since December of 2010. Wow. So almost over 5 years there. And oil up almost $10, surges back into bull market territory after hitting a low of 39, moving back towards $49. So these moves really do get just a continuation as there doesn't seem to be a full marketplace to set them back in line.
Yeah, that's the thing that gets to me is I don't know how much to read off of these because there's not a ton of volume. It might be that just 6 guys took a day off at Goldman Sachs, and somebody else is still in the marketplace. And that's why I find it tough personally to say, okay, that means this is going on or this is going on, because what the explanation might be as simple as some people are out of town.
Exactly. And that's where I've taken the last couple of weeks to try and step away from the day-to-day and look over some longer-term charts and see where things are relative to where they've been over a longer period than just the last couple of weeks. So with that, we've had the U.S. dollar. That's been a key driver of so many markets. So over the last 18 months, it's been between par and 94 cents on the dollar index. So we've come all the way back down to the low end of that range. And if you look at that then over a longer period of time and think that the dollar index is going to stay within the range, then maybe this has given us some opportunities.
Yeah, I mean, that's the thing is you look at the long term. So you've seen nothing in this market that sort of changes your mind about longer term trends like the U.S. dollar as your example. Maybe oil also. I mean, I'm not convinced at all that oil is out of the woods yet. I mean, we watched it rise in the trading markets against a backdrop where Saudi Arabia says it's going to raise production at a time when the demand isn't there.
Well, exactly. We have OPEC and Saudi Arabia together producing at all-time record highs. So the fundamental story behind things haven't changed, but the last 2 weeks has just seen the futures market or the paper market that we see and look at every day really go on a bit of an extended run. But again, I think you have to look a little longer term and say, okay, where does this provide me an opportunity? We saw Canada fall back fairly sharply on Friday. Did it just run too far in thin markets and maybe it's at a good level to look to be on the short side? Has crude run them too far? I mean, it's stayed near the highs, but you're looking at it and saying now might be an attractive opportunity to get on the other side.
Well, as I say, it's an interesting time of year when you do get this sort of August summer doldrums on this one. I'm just the coward. I'm sitting on the sidelines, Drew, and I know you don't get the luxury of it. You have to at least not play the market. You have to be so engaged on a daily basis. Sometimes that means on the sidelines or not. Drew, go out and have a great weekend. I appreciate you finding time for us.
Thanks for having me on, Mike.
Drew Zimmerman, Pacific International. Time now for this week's, my thanks to everyone, by the way, joining us today. And a reminder that Money Talks is brought to you by Solera Club. Solera Club is a royalty-based investment. That means investment terms, you get paid first. There are no fees attached to it, and it's in the tech sector. For more information, go to soleraclub.com. Time now for this week's Goofy Award. You've been watching the Olympics? I have. I loved the men's 4x100 relay yesterday. I loved the women's soccer win over Brazil. I love so much of it, I should say. And once you get into the competition side, I thoroughly enjoy the Olympic Games. But that still brings me to my Goofy. Arguably one of the most ill-conceived, post-Olympic career-killing, stupid acts in the annals of Olympic lore. I'm referring to the much-decorated American swimmer Ryan Lochte, 12 Olympic medals, 6 gold, second only to Michael Phelps in decoration. I mean, this could have been a gold mine for him after he retires from swimming. So what does he do? He makes up a story that he was robbed at gunpoint in Rio. It got worldwide attention. Sure it did. But it was a lie. Lochte and friends had been to a brothel, were intoxicated, and on the way home they vandalized a gas station washroom. The attendant called the police, who demanded they pay for the damage. But his lie, Lochte's lie, is so mind-blowing that one has to seriously wonder if he's got some sort of mental problem. But I'll tell you, whatever his reason, he has changed his legacy permanently. I love the New York press reaction to the real story. This was their headline, "Liar, liar, Speedo on fire." The Daily News headline was, "Locked mess, not monster." San Francisco Chronicle called him the most embarrassing Olympic athlete ever. This literally will cost him millions. His post-Olympic brand is changed forever, and I'll tell you, sponsors aren't going to want to associate with him. Wow, he certainly gets my Goofy. He's going to pay the price. That's all the time we have. I invite you to go to moneytalks.net, join me on Michael Campbell's Facebook, and go out and have a great weekend.